Back speaking with Wayne Paterson this morning from Anteris. Wayne, good morning.
Good morning, Andrew.
Yeah, good to be catching up, Wayne. Significant announcement last week here, this raise, $30 million, well supported. Tell us a bit more about who was behind it.
Yeah, I'm obviously happy with the fact that our largest shareholders, institutions particularly, are supporting the company and supporting their investment as we move forward. I think they fully understand the investment thesis at this point, and the level of risk or lack of risk of this product going through the motions, but for the capital that's required to get it there. It's also our biggest capital raise in our history. So again, very happy that the markets will support the product and the investment thesis to get us through the pivotal study.
Well, exactly. So we've got a fair idea of some of these milestones coming up, but give us some detail as to what the funds will go towards.
Right. So if you look at the history of the company, you can see as we've developed the product, it's probably a generational product. It's very, very superior to what's available in the market from a clinical point of view. The cash burn certainly reflects that course of development. As soon as you get into the clinical trial phase, which is where we are, going through the FDA motions and the different tests and things required, obviously your capital requirements need to support that process. And so that's where we are. Frankly, we spent a couple of $100 million to create a multi-billion-dollar product. I think it's exceptional, and certainly a lot less than what the other products in the market had spent to get through development. So I'm very happy with that. I mean, it is a medical development product. Obviously, we don't have revenue as a company. And I think, investors understand what they're invested in here. It's clearly a development process. I think the important thing is to calibrate risks versus returns here. No matter how the market looks at this, the simple facts are when you get to clinical trial, you've got to make stock, you've got to have trial product, you've got to manufacture, you've got to have clinical support specialists. There's a lot of supporting infrastructure for a clinical trial that gets you your regulatory approval, but we anticipate this product is a multi-billion-dollar product in the market. And so again, it's just calibrating that amount of capital deployed versus the ultimate returns on that. But it's not a trading story right now. This is a stock that you invest in, understand that the risk is very, very low at this point of the product not coming to market, and then that the ultimate reward on the stock comes during the FDA, post FDA, or a bunch of events that could occur in between.
What about the foreign exchange rate currently? That's got to be hurting you a little bit.
Yeah, I pointed this out at the AGM, and it's been there for a few years now. But of course, we spend predominantly in US dollars because our infrastructure, of course, is in Minneapolis. And there's reasons for that. The big one being that it's the medtech center of the world, which means all of these young engineers and bright minds that we have in our company are doing phenomenal things that no one had achieved before because of the infrastructure support in Minneapolis. Now, we get about a 40%, 35 to 40% hit on the reporting of those dollars. And so it does amplify, the capital in terms of it's reported in Australian dollars. It looks a whole lot more, I guess, reasonable when you look at it in US dollars because that's how we spend. No way around it. The Aussie is trading at whatever, 65, 66 at the moment. And appears to continue to be that way for a while. So it is what it is. I mean, the dollars come in and they go out in US dollars, and the reporting will always be 40% amplified to what it actually is in US dollars.
So Wayne, and as far as the FDA phase 3 pivotal study, how's preparations for that going?
Yeah, look, I am really, really happy. I think I've shared this publicly with the markets. I guess if you haven't been through this or you don't come from this industry, you've got to kind of really understand what's behind a study, the study numbers. Obviously, it's not random in how you calibrate the number of patients in a study. It's based on biostatistics. And that's just pure math, and the math supports whether something is statistically important, relevant in a study or not. And so the math informs the size of a study. Where we are today, the biostats support a number that's statistically significant, and we're in and around that number. So I'm really, really happy. I've run studies of 5,000 to 6,000 patients in pharma, These medtech studies are nothing like that size. So they're smaller, they're more compact. The biostats are naturally smaller. And you can get through enrollment as a result far quicker. But, the prep with the FDA is going really brilliantly. I think that it just shows the confidence, not only in our product, but in our team. When we have these meetings, you can see the level of respect from the FDA reviewers, as well as the doctors we work with. The likes of Dr. Reed and Dr. Leon are also formal advisors to the FDA on TAVR topics. And so these are our study co-chairs, which is a huge, huge endorsement for the product, but certainly helps with the FDA. So it's a non-inferiority study. I think that's, fantastic. I think it's right. It's the right primary endpoint, but it's also very good. It's a randomized study, which means it'll be 50% of the patients will be Duravar, the other 50 will be standard of care, both Evolut and Sapien, the Medtronic and Edwards product. We are also able to include the valve-in-valve registry in that study, which is fantastic, which means we don't have to run two studies, get it all kind of one and done. And so, yeah, I'm just really happy with where we are. We've got to go through a few more mandated tests on the bench and a few other things that the FDA require of everybody at this point, and then we get the final approval to start the study.
Well, Wayne, I suppose I'm keen to hear your thoughts on this. You and I spoke numerous times last year when the Anteris share price was sitting, say, early 20s, mid 20s. Since then, a lot of great progress has been made. You've announced some really positive results. You've just raised 30 million. You probably didn't expect to be sitting here today with your share price at 15.
Yeah, and look, it's always a challenge as a CEO where there are things you can control and things you can't control. And every retail investor will certainly have their opinion on this, and I'm happy for them to have those opinions, and I listen to them. I think the fundamental issue is, we peaked out at about $28 or whatever it was with our first human data, which was phenomenal data. And, again, medical development is a process. I'm not sure everybody fully understands maybe what the timelines are and what they're invested in here. My medtech specific investors clearly do. They don't call me up. They don't worry about things. They're like, okay, we know where the endpoint is, which is FDA. So I think it's more the generalists that are, maybe not fully understanding the story completely. But I think at the end of the day, that it's an anomaly. It's a point in time right now. I try, to hear the concerns of folks. I try to alleviate those where I can, but we've got to stay the course. We've got to get our product through FDA. I do have a team of young engineers, people, very big talents, physicians we work with who also look at the share price. I mean, as a barometer of their own labors. And when they understand they've created a generational product here, which they do and have, and nobody had done that before them, they also scratch their head and say, it's a little bit mystifying to them that the product that they've created worth billions of dollars in the market is not resonating necessarily on the share price. I guess I have studied and reviewed a bunch of ASX healthcare companies over the years. I won't name them, but I've also seen pre-FDA companies struggle with the market cap. I mean, they get to where they're going. And so I think you get kind of tarred with the same brush a little bit. And of course, the minute you get FDA, you're a genius and everybody shakes your hand, and you see that with companies today. But we can't be compared with a post-FDA approved company versus where we are in our life cycle. So you've got to really compare apples with apples. I understand the angst out there for sure. I feel it. But I can't necessarily, throttle off on what we're doing. The expenditures today reflect the fact that we're heading into a clinical trial. We built this product on a couple of $100 million, which is phenomenal. And so, the company has demonstrated its ability to produce, exceptional results, which we have. And I think markets have got to remain confident that we are going to go through the trial the same way, get the approval the same way, and so on and so forth. And maybe a few surprises along the way. We do talk, of course, regularly. I've mentioned this before to other companies out there, the big ones. I would say at any given time, there's one or two active discussions going on with these folks. And that's how they work in this space. We've seen this with other companies that have been acquired or partnered up with over time. As they get into their FDA process, these 4 or 5 year old relationships with some of these companies start to really get serious. And so we're in a very good spot from a progress point of view. We're in a very good spot from a product point of view. Obviously, with the results we've got, the level of risk is very, very low at this point. But for the share price, everything else is really going very, very well from an internal perspective.
Good to catch up, Wayne. Thanks for your time.
Thanks, Andrew. Appreciate it.